You know what nobody tells you about financial freedom? It doesn't require $1 million lottery ticket. It requires 3 dividend ETFs and basic math that your employer hopes you never discover. Right now, while you're reading this, there are people collecting enough dividend payments to cover their entire monthly expenses. Not from trading stocks all day, not from cryptocurrency gambling, from holding just 3 ETFs that pay them every single quarter like clockwork. I'm about to show you exactly how these 3 dividend ETFs could replace a typical American salary. And more importantly, why the math is so simple that Harry, someone who failed algebra twice, built his entire escape plan around it. These aren't random picks from Reddit forums. These are battle-tested funds managing hundreds of billions in assets, paying investors through every market condition imaginable. Now, before we dive deep, this is educational content about investment strategy, not personalized advice. Everyone's financial situation is different. Here's what's coming. 3 specific ETFs that together create a dividend income machine. The exact math on replacing $60,000 in annual income. And why starting with even $5,000 today beats waiting for the perfect moment. Let's start with an uncomfortable truth. Your salary is someone else's investment. Every hour you work generates returns for shareholders you'll never meet. Every project you complete increases someone else's dividend payment. Harry realized this during his 10th year at the same company. Same desk, same commute, same promise of next year's promotion. That's when he discovered something that flipped his entire perspective on income. Dividend ETFs that pay you for simply existing as a shareholder. No performance reviews, no asking for raises, no office politics, just quarterly payments that hit your account whether you're awake or asleep. But here's where most people get it wrong immediately. They think dividend investing means picking individual stocks and praying the company doesn't cut its dividend. That's not what we're discussing today. ETFs, exchange-traded funds, spread your risk across dozens or hundreds of dividend-paying companies. One fund, instant diversification, professional management. And the 3 I'm about to reveal have track records that would make your 401k jealous. The first one has increased its dividend for 14 consecutive years. Think about that timeline. Through 2008's financial crisis recovery, through COVID-19, through inflation spikes, 14 years of growing payments to investors. That fund is VYM, Vanguard High Dividend Yield ETF, currently yielding 2.50% with $79.51 billion under management. But that yield number alone is misleading. Here's what actually matters for income replacement. VYM holds 583 different dividend-paying companies. Top holding, Broadcom at 6.84% of the fund. Second, JP Morgan Chase at 4.15%. These aren't speculative tech startups. These are the companies that run the American economy. Over the past 5 years, VYM delivered a 96.58% total return. Let me translate that. Every $10,000 invested 5 years ago is worth $19,658 today. Nearly doubling your money while collecting dividends every quarter. Harry's first investment was exactly $10,000 in VYM. At 2.50% yield, that generated $250 in year 1. Not life-changing, yet. But dividend investing isn't about the first year. It's about what happens when you keep adding and reinvesting. VYM's 5-year dividend growth rate sits at 3.59%. That means your $250 in year 1 becomes $259 in year 2 without investing another penny. Small increases? Sure. But we're just getting started. Because Harry understood something crucial about building dividend income. You need multiple streams with different strengths. VYM excels at growth with moderate yield. But what if you want higher immediate income? That's where the second ETF enters the strategy. HDV, iShares Core High Dividend ETF. This fund takes the opposite approach from VYM. Instead of 583 holdings, HDV concentrates on just 83 companies. Instead of moderate yield, it delivers 3.35%. That's 34% more income than VYM from day 1. The concentration shows in its top holdings. ExxonMobil commands 8.65% of the fund. Johnson & Johnson follows at 6.77%. These are dividend aristocrats, companies that have paid dividends for decades. Harry added $10,000 to HDV 6 months after starting with VYM. That's $335 in annual dividends from HDV alone. Combined with VYM's $250, he was generating $585 annually from $20,000 invested. But here's where HDV reveals its trade-off. The 5-year dividend growth rate? Just 2.00%. The dividend actually decreased 4.80% this past year. Higher yield today often means lower growth tomorrow. That's the balance every dividend investor must understand. You can't maximize current income and future growth simultaneously. Or can you? Harry kept researching, knowing there had to be a sweet spot, a fund that balanced meaningful yield with serious growth. Something that could form the backbone of an income replacement strategy. That's when he discovered the fund that changed everything. SCHD, Schwab U.S. Dividend Equity ETF. This is the fund that makes other dividend ETFs nervous. Current yield, 3.73%. That's higher than HDV's 3.35%. But here's where SCHD gets interesting. 5-year dividend growth rate, 10.87%. Not 1%, not 3%. Nearly 11% annual dividend growth. The fund has increased its dividend for 13 consecutive years. With $71.75 billion in assets, SCHD isn't some hidden secret. It's the dividend fund that institutional investors pile into. Look at the holdings. 103 companies, perfectly balanced. AbbVie at 4.45%, Chevron at 4.36%, Home Depot at 4.30%. No single holding dominates. No sector concentration risk. The expense ratio? Just 0.06%, same as VYM, lower than HDV's 0.08%. Harry immediately understood SCHD's significance. This wasn't just another dividend fund. This was the cornerstone of income replacement. He shifted his strategy entirely. $30,000 went into SCHD over the next year. At 3.73% yield, that generated $1,119 annually. His total portfolio now, VYM, $10,000 generating $250. HDV, $10,000 generating $335. SCHD, $30,000 generating $1,119. Total invested, $50,000. Total annual dividends, $1,704. Still nowhere near replacing a salary. But Harry wasn't thinking linearly anymore. He was thinking exponentially. Here's the math that changes everything. With SCHD's 10.87% dividend growth rate, that $1,119 becomes Year 2, $1,241. Year 3, $1,376. Year 5, $1,691. Year 10, $3,084. Without investing another dollar, just from dividend growth alone. But Harry wasn't stopping at $50,000. He implemented a systematic investment plan. $1,500 monthly across all 3 ETFs. Every bonus went straight to investments. Every tax refund. Every side hustle dollar. The progression looked like this. Year 1 ending balance, $68,000. Annual dividends, $2,312. Year 2 ending balance, $88,000. Annual dividends, $3,168. Year 3 ending balance, $110,000. Annual dividends, $4,235. Year 5 ending balance, $160,000. Annual dividends, $6,432. That's $536 monthly in passive income by year 5. Enough to cover a car payment, or groceries for a family, or health insurance premiums. But the real transformation happens at scale. Let's talk about replacing an actual salary. The median American income is roughly $60,000. After taxes, that's about $45,000 or $3,750 monthly. To generate $45,000 annually from dividends at an average 3.5% yield, you need $1,285,714 invested. Impossible? That's what Harry thought, until he modeled the compound effect. Starting with $50,000, adding $2,000 monthly, reinvesting all dividends, assuming 7% annual appreciation plus dividends. Year 10, $468,000 portfolio, $16,380 in annual dividends. Year 15, $821,000 portfolio, $28,735 in annual dividends. Year 20, $1,342,000 portfolio, $46,970 in annual dividends. Full salary replacement in 20 years. But here's what most people miss entirely. You don't need full replacement to transform your life. Harry discovered the power of milestone thinking. First milestone, $500 monthly to cover the car payment, achieved in year 4. Second milestone, $1,500 monthly for the mortgage, achieved in year 8. Third milestone, $2,500 monthly for all fixed expenses, on track for year 12. Each milestone reduced his dependency on employment income. Each quarter brought more breathing room. The Sunday night anxiety about Monday morning? It fades when dividends cover your basic needs. But let's address the elephant in the room. Market crashes, recessions, black swan events. Here's SCHD's performance during COVID-19's crash. March 2020 low, $43.74. Current price, $27.36. Wait, that seems wrong? No, SCHD has since split and recovered. The fund continued paying dividends through the entire pandemic. VYM's COVID response? Maintained quarterly payments, never missed one. HDV's 2020 performance? Slight dividend reduction, then recovery. These funds are designed to weather storms. They hold companies that profit in any economy. People still buy Pepsi in recessions. They still pay Verizon bills. They still shop at Home Depot. That's the stability Harry was building toward. Not market timing, not day trading. Just consistent accumulation of quality dividend ETFs. Today, 7 years into his journey, Harry's portfolio generates $18,000 annually. That's $1,500 monthly in passive income. He still works, but differently now. He negotiated remote work 3 days per week. He turns down projects that don't interest him. He takes actual vacations without checking emails, because he knows that every quarter, like clockwork, VYM pays on the 30th, HDV pays on the 19th, SCHD pays on the 30th, 3 payments. 3 different sources. Building toward inevitable independence. The strategy is almost boring in its simplicity. 40% in SCHD for balanced growth and yield. 30% in VYM for long-term appreciation. 30% in HDV for immediate income. Rebalance annually. Reinvest dividends during accumulation. Never panic sell during corrections. But here's the critical mindset shift. This isn't about becoming rich. It's about becoming free. Free from mandatory meetings about nothing. Free from asking permission for time off. Free from the fear of unexpected layoffs. Every share of these ETFs is a small piece of that freedom. Harry calculated something recently. If he'd started 5 years earlier, he'd be financially independent today. If he'd waited 5 more years, he'd need to work until 70. The difference? Starting. Not with perfect timing, not with maximum capital, just starting with what he had. Your situation might be different. Maybe you can invest more, maybe less. Maybe you have higher expenses, maybe lower. The math doesn't care about your specific numbers. It only cares about 3 things: time in the market, consistent contributions, dividend reinvestment, VYM for growth and diversification, HDV for immediate yield, SCHD for the perfect. Balance of both. Together, they form a dividend trinity that could genuinely replace your employment income. Not overnight, not without discipline, but with mathematical certainty over time. The question isn't whether this strategy works. The question is whether you'll start this month or spend another decade wondering what if. Harry's only regret isn't about which ETF he chose first. It's about the 5 years he spent researching instead of just beginning. Every quarter you delay is dividend income you'll never collect. The path to income independence isn't complex. 3 ETFs. Consistent investment. Patient accumulation. Your employer won't tell you this is possible, but the math doesn't lie, and neither do quarterly dividend payments.